All right, hey. So Thomas Laffont just told everyone we're walking into a $4 trillion AI IPO supercycle with no historical precedent. 4 trillion. That's roughly the entire market cap of every AI company that exists right now about to go public. And then Kevin from Meet Kevin immediately said that's complete nonsense and that OpenAI's fundraising pitch is basically a con. So here's the thing, both of them are looking at real data. One of them is right. Or maybe they're both kind of right and both kind of missing something. Let me unpack what's actually happening. Thomas Laffont runs CO2, a hedge fund with 55 billion in assets under management. He's not some YouTube guy throwing predictions at the wall. He's saying the AI IPO wave is coming because the funding composition of venture has fundamentally shifted since 2021. Before you had crypto unicorns, fintech unicorns, logistics unicorns. Now, it's basically all AI, not half, not 70%. He's arguing that somewhere around 90% of new unicorn funding is going to AI-adjacent companies. That part is actually true. You can verify it. The venture landscape has consolidated into AI. OpenAI got 12 billion, Anthropic raised 5 billion, DeepSeek's getting funded somewhere in the cloud. Even non-AI companies are being revalued if they add an AI feature. So the pool exists. But then Kevin's looking at the same market and seeing something different. He's specifically targeting OpenAI's fundraising narrative. The CFO went on stage and said they have cash on the sidelines. They're not desperate for money. They're just raising because this is the moment. Kevin's saying that's backwards signaling. If you had cash on the sidelines and you weren't desperate, why would you raise 12 billion at that valuation? And I get both arguments. Here's where it gets interesting, though. The 4 trillion number isn't total IPO proceeds. It's the implied market cap of companies that could go public in the next few years if the AI supercycle plays out. That's different. IPO proceeds are usually 20–30% of market cap. So if 4 trillion in market value goes public, that's maybe 800 billion to 1.2 trillion in actual new capital hitting the public markets. That's significant but not insane. Where Laffont's probably right. The shift is real. Venture has moved, capital allocation has moved, and there's probably a 3 to 5 year window where a lot of these AI companies go public at high valuations because there's nothing else to buy. If you're a mutual fund and you need growth exposure, what are you buying? This or some boring software company? Yeah, you're buying the AI play. Where Kevin might be onto something. A lot of these companies don't have business models that justify the valuations yet. OpenAI's revenue is billions, but margins are tight, compute costs are brutal, and they're competing with everyone from Google to Anthropic to open source models that are getting better weekly. The idea that they'll dominate is real. The proof that they'll be worth $200–300 billion in 5 years is not. Here's how I'm thinking about it. The IPO wave probably happens. Capital needs to deploy somewhere. But the pricing probably doesn't hit 4 trillion in aggregate market value. Some of these companies crater post-IPO, some turn into real giants. Most probably end up as stable, profitable, mid-cap software companies trading at reasonable multiples. The disagree point between Laffont and Kevin is really about timing and valuation discipline. Laffont's betting on the scale of the wave and the willingness of public markets to pay a premium for AI. Kevin's betting that at some point, the market wakes up and asks what these companies actually earn and what they actually do. Both things can be true. The wave happens and the valuations disappoint. Or the wave is smaller than Laffont thinks, but the winners are bigger than Kevin expects. This is one of those situations where the best strategy is probably boring. The companies with sustainable unit economics, actual revenue, and defensible moats probably go public and do fine. The ones that are just hype probably don't. And that's the thing nobody talks about. Not every unicorn goes public. Not every IPO succeeds. And the 4 trillion number is a ceiling, not a floor. So is it a red flag or reality? It's probably somewhere in between. The capital is real. The shift is real. The hype is definitely real. Whether the returns match the narrative, that's still being written. And speaking of things that seem too good to be true, a woman in her late 30s spent 14 months pretending to be a 12-year-old girl to get adopted into a family. Not a weekend con. 14 months of maintaining the act, sleeping on a kid's bed, going to school, the whole thing. The family eventually figured it out, and it was this whole legal mess. Wild. Just absolutely wild. Okay, I'm out. Drop a comment if you want me to dig into any of this further. Take care.